Hello and welcome to our discussion of absorption versus variable costing and the difference in how the two methods handle fixed manufacturing overhead. First of all, here we're talking about two different methods of product costing. Understanding what the product cost is important for both managerial and financial accounting. In fact, this is one area where managerial and financial accounting tend to come together with the cost of inventory or product costing. So again, that's what we're trying to do here is determine what the cost of the inventory is so we can determine how much becomes an expense and how much remains as ending inventory. So we're going to talk about two different methods. This information is important to managers to help them understand their costs, control them, to set the prices based on the cost, and to evaluate the performance of a particular manager or division or product line for performance evaluation purposes. So again, we have two separate methods we're going to be focusing in on here. The first one is known as the absorption method. The second one actually has a couple of names, variable or direct costing. They're both the same thing there. The difference between these two methods is going to be in what is considered a product cost versus what is considered a period cost. Now keep in mind, product costs are expensed at the time the product is sold. So if you have a lot of product you've been building, you have a lot of cost there, but if you haven't yet sold it, it's not going to become an expense until it's sold. On the other hand, with period cost, it's expensed right away in that period, regardless of production or sales or anything else. Now, what we'll find here is out of all the different components of product cost, the one thing that's different between the two methods is how fixed manufacturing overhead is treated. Under one method, it's going to be considered a product cost, and that's the absorption method. Under the variable or direct costing, it's going to be considered a period cost. In other words, it's not a product cost under that method. It's the variable direct costing method only considers variable costs to be product costs. So again, you may question, why does this matter? As I alluded to earlier, it's all about the timing of expense recognition. If you are using the variable or direct costing method, then that fixed manufacturing overhead is going to get expensed that period regardless of what production it related to and regardless of whether those units have been sold yet or not. But if you're using the absorption method, that fixed manufacturing overhead only gets recorded as an expense when the product is sold. Now, again, that's what those last two bullet points are saying. The product costs are recognized as expense upon the sale of the product. The period costs are recognized as expense that period. Doesn't matter what was sold or what was produced. So let's take a look at the various product costs, or the various costs in general. Direct materials and direct labor, they're always considered a product cost. They're always variable, but really that doesn't matter. They're always considered a product cost no matter what method you're talking about. Now, manufacturing overhead, we're going to split into two pieces. Variable manufacturing overhead is going to be considered a product cost because, again, it is a variable cost. Therefore, even under the direct variable costing method, it's still going to be considered a product cost. It's related to manufacturing, so you can easily see the tie to the manufacturing overhead side or to the product cost side. And again, the fact that it's variable allows it to stay as a product cost instead of being excluded under the direct variable costing method. Now, fixed manufacturing overhead is going to be the different factor. This one depends on the method. Under the absorption costing method, what we're saying is we're assuming that every unit that comes through absorbs a piece of that fixed manufacturing overhead. Now the reason for that is that you can't build any products unless you have that fixed manufacturing overhead. That's basically your capacity, your machinery, your buildings, all of those fixed costs. You can't do anything without it. So under the absorption method, we want to know what that full cost is, including that capacity cost. So fixed manufacturing overhead under the absorption method, it is treated as a product cost. But under the variable costing method, the thought is we only want to know those items that directly relate to an individual product, which would be all of our variable product costs. Now let's go down to the selling and administrative costs. We have variable and we have fixed. Those, by their nature, never relate to production. Instead, they're the selling, the running the company overall. So they are never a product cost regardless of which method you're using. So this is another illustration of this. Variable costing, the product costs, it includes all of our variable costs that directly relate to the product. So direct materials, direct labor, and then the variable manufacturing overhead. Absorption costing is going to have all three of those plus fixed manufacturing overhead. Now remember, fixed manufacturing overhead has to go somewhere. So if it's not considered a product cost under variable costing, for example, then it becomes a period cost. But under absorption, we don't have to worry about it being a period cost because it's already included as a product cost. So let's focus in on the absorption costing method here. We are going to use the traditional income statement when we use this method. This is where we have the sales less cost of goods sold to give us gross profit. And then from that we subtract out the selling and administrative costs, the period costs to get net income. So that traditional income statement method, it focuses on product versus period right off the bat. The product costs, again, whether it's fixed or variable, they go under the cost of goods sold. So that cost of goods sold will include some of our capacity or our fixed manufacturing overhead. Again, as I said earlier, each unit of production absorbs a bit of that fixed manufacturing overhead. We try to allocate a bit of that out. We calculate a predetermined overhead rate, and every unit gets maybe $2 or $3 of overhead. Now, because that is considered as a product cost, that fixed manufacturing overhead gets included with the inventory wherever that inventory is reported at the time. So if the inventory has not yet been sold, it's considered an asset. Therefore, we have a lot of that fixed overhead stuck as an asset. It's deferring the recognition of an expense. If it was considered a period cost under the direct variable costing method, then that fixed overhead would be immediately recognized as expense. So absorption, again, essentially defers the recognition of fixed manufacturing overhead until the unit is sold. Then it will be converted to an expense, cost of goods sold. So here we have an actual valuation example. This Ready Steady Incorporated produced 1,500 bottles of their workout supplement shake. Each bottle has a direct material cost of $220, direct labor cost of $175, and then they give us total manufacturing overhead of $235 per unit, but then they say 85 cents of that is variable. So we can calculate the fixed by taking $235 minus 85. That gives us $1.50. Selling price is $12 per bottle, but that's a price, that's not a cost. The selling administrative costs are 65 cents per bottle plus a fixed $2,500 per month. So our first challenge would be calculating the actual product cost. Now I have the two columns here side by side. Remember that direct materials and direct labor, they're obvious candidates for product costs, so there's no question they're always going to be included. Now, even though manufacturing overhead by its nature is not direct, it still relates to production. It's not direct to a particular unit, but it's directly related to production. So that variable manufacturing overhead of 85 cents per unit, under both methods, that's going to be considered a product cost, no question. Now we get down to the fixed manufacturing overhead. Again, that's $1.50 per unit. It will be considered a product cost under absorption costing, but it will not under variable. Instead, under variable, we're going to take the entire amount of fixed manufacturing overhead per month, which in fact they haven't even given us that number. We'd have to figure it out. But that total amount per month would be considered a period cost, and it would not go under the product cost. So what this means is if you're looking at just your costing, your product costing, the absorption costing is going to have a higher cost, $6.30 versus $4.80. The difference, of course, is the $1.50 fixed manufacturing overhead. So now let's take a look here at what happens to that absorption method depending on how our sales compare to our production. So first let's look at a situation where sales and production were equal. So in other words, we sold everything we produced. We have sales. We subtract out that $6.30 per unit cost of goods sold multiplied by 4,500 units. We get gross profit, and then we subtract out our selling and administrative expenses. Now, in that case, all of our fixed overhead was eventually converted to cost of goods sold because we sold everything we produced. But now let's say the next period we still produce 4,500 units, but now we only sell 4,000 units. So now what's happening is that we have, for 500 of those units, we have the fixed manufacturing overhead that's not being considered as an expense yet. In fact, none of the cost of goods sold for those 500 units is considered an expense. It's going to be considered an asset until we sell it. But what we really want to focus in on in comparing these two methods is that, was it $1.50 per unit, I believe, that was fixed overhead? Under the absorption method, that's not going to be considered an expense right now. But under the variable direct costing method, it would have been expensed right now, even though we didn't sell all of the units. The entire amount of fixed manufacturing overhead would have been considered period cost under the variable costing method. So what this means here is we have less sales because we sold fewer units, but we also have less cost of goods sold. Overall, it's going to end up with less net income just compared to itself, this same method. But now let's take a look here. We now are selling more units than we produced. Now the reason we can do that is that we had some units left over from year 2. Now we're selling them all plus some. So we have our sales, we subtract out our cost of goods sold to get our gross profit, and then we subtract out our variable and fixed costs. So just keep in mind how the net income changes under those different methods. Now, if we were using the variable method instead, now notice how the income statement looks different, first of all. Now it's sales less all of our variable expenses, including both the variable product expenses, and the variable selling and administrative. We're subtracting out both of those now, and we arrive at a contribution margin, and then we turn around and subtract out both fixed expenses. So we don't have a gross profit figure under this method, and that's fine. But now if we take a look here, we have 20,225 in that situation where we sold the same number of units as we produced. Notice we have quite a bit less in the of net income in the situation where we sold fewer units than we produced. Now, let's take a look at this for a second. 16,950. This is the variable method. Let's jump back. Under the last method, our net income was higher under that same scenario, 17,700. The reason for that is that under the variable method, we're counting the entire amount of fixed manufacturing overhead as an expense this period, even though we didn't sell all the units. So we have a lot more of expense under the variable method, whereas under the absorption method, some of that fixed manufacturing overhead would have been deferred. It would have been stuck in the product cost for the 500 units we did not sell. It would have been an asset instead of an expense. Now, if we take a look at the situation where we sell more than we produce, and if we compare the two methods here, now variable has 23,500 of net income, whereas absorption had less, 22,750. The reason for this is under the absorption, we were counting all of that extra fixed manufacturing overhead as product cost now that we sold the units. So it basically had more than a year's worth of product cost, whereas under variable, we just have the year of product cost regardless of how many units we sold. So the difference between the two, it's always going to be that $1.50 per unit of the fixed manufacturing overhead multiplied by the number of units that have been produced but not sold, or vice versa, if we sold more than we produced in the next year. That's going to be the reconciliation. 500 times $1.50, that's where we get our $750. Now, this is a good summary of how each of these methods changes when production equals sales, when production is greater than sales, or when sales is greater than production. Now, let's first of all, before we go through each one, let's take a look at the columns and understand the relationship here. Ending inventory is just kind of by itself, but then we have cost of goods sold. If we have higher cost of goods sold, we're going to have less operating income, and vice versa. So once you understand one of these, you'll understand the other, because it's going to be the exact opposite. So again, if production equals sales, if we do not have any difference, we don't have anything stored per se, we don't have anything stored in inventory, then there's going to be no difference between the two methods. If our production is greater than sales, then we're going to have a lot of that cost that's going to be stuck as an asset. That fixed manufacturing overhead specifically is going to be stuck as an asset, and we'll have a higher ending inventory. Because that extra cost was stuck as an asset, our cost of goods sold is going to be less under absorption, because again, that cost is asset, not expense. Compared with variable income, now since absorption costing has less cost of goods sold, it's going to have higher net income. But if we reverse the situation where the sales exceed the production, now all of a sudden we're having a situation where the absorption costing cost of goods sold is going to be high. Because again, we're not only using 1 year's worth of fixed manufacturing overhead, we're using overhead from some of those units in the prior year that were stored as assets initially. Now they're being expensed. Since that cost of goods sold is higher, the absorption costing income is going to be less than it would under variable costing. So that should be a good summary of how the two methods compare at the three different scenarios as far as the production levels. Thank you for watching my accounting video on YouTube.com. I hope you've enjoyed that information. Accounting can be a difficult topic to conquer, and sometimes you just need additional information or assistance outside of the classroom. If you feel like you need some additional information, some additional resources, come visit my Udemy.com course. I have a variety of financial and managerial cost accounting courses available that may be able to assist you if you're having trouble with a particular course. In these courses at Udemy.com, I have additional lectures on a variety of accounting topics. We also have downloadable Excel templates for all of the various practice exercises we work, as well as a video walkthrough of the solution. I continue to update these practice exercises, so even after you join, you may see some new exercises. It's all geared toward helping you to understand the topics. So in addition to those additional lectures and the practice exercises, we also have quizzes and tests to help gauge your understanding of the topic. That may give you a better idea if there's something you need to go back and learn a little bit more about, read more about, watch a video on. We also have downloadable study notes that really try to drive that home. There's a downloadable textbook with it. So feel free to come join this class, come take a look at it. You can find this at udemy.com if you search for Severson, or you can just Google Severson Udemy Accounting to see a list of all the courses that are currently available. Again, I'm working on new courses as we go. Right now you'll see some financial and managerial accounting courses out there. I'm working on the intermediate and advanced side of those particular courses as well, so you may see new ones out there as well. Now, email me for a special 50% off coupon code. You can send an email to chrisseverson@hotmail.com, and I will respond with that code. It's a different code for every course, depending on which one you want. I can also respond with the actual link to that course. Now, all courses at udemy.com have lifetime access, and there's also a money-back guarantee if you're not satisfied. So come check out my course at udemy.com and see if it may be a fit for you. Thank you for your time.